Welcome back. Delhivery is a stock which is on my radar because there has been a substantial intraday recovery. Now, Delhivery opened below 300 rupees. That was the opening level on Delhivery. This compared with the closing price of 315 yesterday. So straight away at open, the stock was down nearly about 5%. But intraday, you've seen that buying coming through in Delhivery from the day's low. It's recovered close to about 7.5% now and is back in the green now. Remember, came out with their numbers. On the top line, very muted. Revenues were down 9% year on year. On a quarter-on-quarter basis, revenues were only up 1.5%. So there was clear weakness in demand seen at the top line. What the street is latching on to is the fact that on a quarter-on-quarter basis, the profitability or the losses are reducing. So at the bottom line, this quarter, the company reported a loss of 195 crore, but it compares with a loss of 250 crore in the September quarter. So demand is weak, that's hurting the top line, but at least at the profitability level, sequentially, there has been that bit of an improvement. Nykaa, on the other hand, has slipped to the low point of the day. Nykaa reports their numbers later, usually post-market us, so we'll be tracking that very closely and what they have to say about the margin performance from here on. But another group of stocks that we've been looking at, they've been in the spotlight now for nearly a fortnight, are the Adani Group stocks. And today, they continue to see selling pressure. This is even as State Bank of India has clarified to CNBC-TV18 that more shares were sought to meet the mark-to-market slips on their existing loans, and there has been no communication from the group for new loans. Listen in to an excerpt from our conversation with J. Swaminathan, the MD of State Bank of India.
We have an exposure of US dollar 300 million facility that was granted for the Adani Group's Carmichael facility in Australia. Of which they have drawn down USD 180 million towards the railroad part of the project, while the mines they have so far managed to complete with their own resources. So there is one of the covenants for this facility is that they should maintain 140% collateral coverage. In addition to the project assets, they are required to maintain this collateral coverage by way of pledge of shares from the three companies belonging to the group. This is not any loans that was granted against pledge of shares. No additional finance was granted against this additional pledge. These are essentially to maintain a covenant that is pre-existing in terms of an earlier facility, which is completely covered both by project assets as well as this collateral coverage.